we sort of try to stay dynamic to fit with where the opportunity is, where the market moves, and where the trends are, without being sort of hype driven, because I think pure hype driven is not proving to generate returns.
This podcast is brought to you by Fredrik Herstad and powered by Unlisted, the leading cap table management platform in the Nordics. Produced by Amplitude Ventures, your partners in early stage music tech.
Hi, and welcome to a new podcast episode. This time we have Arne Tonning with us from Alliance Venture. Welcome, Arne.
Thank you, Fredrik, for having me.
Please start by explaining who's Arne. What's your background, and how did you end up in venture capital?
Yeah, I'm starting to be grown up now, so it's a long story, and quite frankly, I've been in venture so long that that's really my profession and what I do. I've been in venture for more than a decade and a half, but it still took a while to get there, and it was sort of not a straight line. I'm originally a technologist engineer and started as a research scientist. Ended up going to London, working for the Norwegian government as a technology advisor, where the idea was to work with Norwegian industry and research and collaboration with the UK. In reality, I ended up working with Norwegian tech companies expanding into the UK and sort of in a more market-oriented capacity, and ended up working with a few companies that raised money in London, where I met some venture capitalists. And I figured out that seems like the interesting thing to do. I'd like to do that, and got really passionate about that, and started to say, okay, how can I get that job? Obviously, I had no real qualifications for that at the time, but started nerding about venture capital and trying to learn everything, talking to a bunch of people, reading a bunch of stuff. Went home to Norway, went into management consulting, sort of to prove my commercial capabilities while still searching. And then an opportunity opened up at Alliance, and I got in as a junior in the team, and I've been here ever since.
Yeah, great. So it's funny talking to a lot of VCs, and I see a lot of them start with or as technologist and end up as investor. So it's a kind of an interesting road. So please tell me about Alliance Venture.
Yeah, so Alliance is a Nordic early stage VC. We're 6 partners, 3 in Oslo, 2 in Stockholm, and 1 in Copenhagen. Started originally as a Norwegian VC, aiming to bring Silicon Valley style VC to Norway, and also build bridges out to larger global markets, in particular the US West Coast. But I've since transitioned into being a Nordic VC.
So does that mean, so you have also office in Oslo? That's your HQ?
It's the biggest office, but we're actually legally registered in Sweden since 2020.
Yeah.
So,
okay.
So from a legal perspective, Sweden or Stockholm is the HQ.
Yeah. So you have an office in Stockholm as well, then?
Absolutely. So we're sort of reasonably balanced between Norway and Sweden, and working our way to a bigger position in Denmark and Finland.
Okay, interesting. So how would you say, like roughly, what's your kind of distribution investments through the different countries in the Nordics?
So historically, if you look at the whole history of Alliance, it's been heavily tilted towards Norway. Now it's sort of more balanced between Norway and Sweden, so I would say maybe 40% there, and then maybe 20% outside of that. Then we're leaning into Denmark in particular now, since Stine came on board as a latest partner, and she's based in Copenhagen, and has really good networks and relationships with founders in the Danish ecosystem.
Yeah. What would you like? Since we're talking about the Nordics, do you see any kind of similar traits across the Nordics within the companies and founders that you invest versus others? Maybe a big question, but
I think there are global common traits, right? So technology trends are very global. Entrepreneurship and the wave of entrepreneurship and changing the world rapidly by building tech companies that grow rapidly and changes the way that we work and live. All of that and sort of the ambition around founders and so forth are common traits. There are sort of more smaller differences in the type of talent bases you have in different countries, the sort of the industrial base of the different countries, the sort of the how far along you are in building the ecosystem, and therefore also the kind of companies that are being built there, and also how angel investing works in those different countries. So there are a bunch of differences, but I would say the commonalities are bigger than the differences, and sort of I'd say there's a uniform positive wave bottoms up in all the countries.
And you said you invest in early stage. Could you elaborate a bit on that? Like how early, what typical stage do you go in at?
Yeah, so I think we're reasonably dynamic, and more dynamic than I would think most are. But I'd say our sweet spot is seed, and leading or co-leading seed rounds. So we would invest €1 million or $1 million at seed, and that's maybe our medium investment. But I think what are the rounds and the dynamics of that there are like enormous pre-seed rounds and there are small A's, and so being too label oriented or too formalistic in how you invest is not the way to go. So I would say our dynamic range is pre-seed to Series A. Series A, if it's a big international Series A, obviously we're not a size of fund and ticket size that we can lead. But then we're maybe a co-investor with a larger international fund or something like that. And then we can be sort of more a leading player in pre-seed and seed. And I would say the ticket sizes are for maybe €300,000 or something like that, up to 3 million euros, although I think it'd be a stretch to go all that way, but in theory we can do that. So so we have a pretty dynamic range, and we're also reasonably flexible on ownership. To us, the quality of the company is more important, and the potential of whatever money we put in is more important than the specific ownership targets. Although there's obviously also like a lower bound to where it makes any sense.
And you just closed a new fund, right?
We did indeed. So we're very happy about that. We announced it. Thank you. So we announced that early June, and had a first close we announced it early July and had the first close in June this year. So fresh capacity to invest, and looking forward to find great founders to partner with in the next few years.
Yeah, that's awesome for all the founders out there, especially during tough times.
Absolutely.
Yeah. So and the mandate, kind of the same. Haven't changed anything on that.
Yeah, I think we're sort of on an evolutionary path. There's no massive changes, but it is important to stay dynamic. So if you do the same thing that you've always done, you're not moving with the market or the trends or so forth. And also, so I'd say the areas where we sort of move in is geography, where we're sort of gradually expanding our footprint in the Nordics, and with a bigger ambition to be like a leading player across the Nordics. That's one move. I think technology trends always move. We're in the midst of a big AI wave, but ultimately it's about finding, the technology that makes the most change and brings the most value, and apply that technology to real world problems, to both solve problems for customers, but also then build a lot of value. So I think venture works best where there's sort of the steep trajectory of change is, and technology trends play into that. So we're obviously very, very interested. So we've been investing in AI for more or less a decade, but the kind of AI has changed over the time, and also what it impacts changes over time. So we're sort of dynamic around that. We've always invested in sort of business efficiency. And so historically, we've had a lot of B2B SaaS companies for example. We think, the delivery of that and the business model maybe changes, but we still think like businesses deploying AI software data to improve their operations is still a very hot topic. So we stay within that field. We've historically invested in climate and energy. We continue to do that. We're typically not in the sort of asset heavy parts of that. But we stay, even if sort of the hotness is on and off, we still think that it's very aligned with, resource efficiency and the business cases around, digital solutions for that is still a big opportunity. So it's about finding the right companies with the right model in those spaces. We historically invested in fintech. We will selectively do so also going forward and have had success doing that. That's not the hottest segment today, but the right companies there are still going to be massive and valuable. So we continue to do that, but obviously it's not going to be the majority of the portfolio. And then maybe the last area where we sort of activity has picked up is sort of digital health. And there's a number of reasons why we do that. And also, once again, we're selective. We're not going to do phase 2 drug development projects or something like that. It's aligned with, AI and digital technology changing the world. But we think, the two reasons for it, Denmark and Sweden are more leading countries within this field. So it sort of aligns with our geography. It aligns with the talent that we're onboarding. So Anders in Sweden and Steen in Denmark have real experience in this field. And it's a huge industry where that has been a lagger. And so it's sort of built up need to do something to drive productivity. So we think it's an interesting field with lots of value done right. So we have done 2 investments in that space now, and we'll probably do a few more. It's also not going to be like a dominant in volume part of our portfolio, but we think it's a very interesting field. So I think, we do what we do, but we sort of try to stay dynamic to fit with where the opportunity is, where the market moves, and where the trends are, without being sort of hype driven, because I think pure hype driven is not proving to generate returns.
Wow. So like you're early stage, you're industry agnostic, and across the Nordics, sounds like you have a big deal flow coming your way.
Absolutely. And so, I was planning to go on vacation this year and did, but sort of announcing a new fund right before going on vacation is actually a recipe for not having that much vacation and just having a challenge, responding promptly and sorting through it. So those who have not received a prompt answer, apologies for that, but that is part of the explanation for that.
Yeah, I guess if they listen to this, then I hope you're excused.
Yes, I think a core tenet is to treat founders well and serve them well, and answering promptly is one of those service attributes that a VC should have. And
totally
then
agree.
I also think living up to that with an announcement right before the vacation it makes it challenging to hold that service tenant, so to speak.
Yeah. But I guess a lot of founders can relate, right? Always being busy, and the holiday comes up, and founders should take holiday. If they have family, they don't have much of a choice either. So I think they can relate.
Yeah.
Speaking about founders, I think one of the things that sticks out when you visit your website is that you focus on founders. Can you say something about that? Why this focus on founders, and what do you look for in founders?
Yeah, that's a really, really big question, right? So why do we focus on founders? So I think the earlier you invest, so the more important the founder is. The founder is always important, but you can kind of when you look at the tabloid version of what you're looking for people or team. You're looking for a big opportunity, also translated as TAM, and you're looking for traction, essentially. But traction can be sort of indirectly traction in or hypothesis of traction in that, you're pursuing an idea or building a product that you believe will be big and generate that traction. But the earlier you invest, and you can discuss how much weight you put on these tabloid dimensions of what you're looking for. But I think the earlier you invest, the more important the founders are, because the one thing you can be absolutely sure about is that things will not go according to plan, and even the best plan, will be hit in the face by realities or changing markets or changing tech trends or whatnot. So I'd say if you're doing a pre-seed deal, it's a 98% founder bet. If you're doing a seed deal, that percentage drops because you have more other data, but it's still the by far dominant factor. And then, as the company matures, I think founders are still important, but obviously not. There are so many other things in the businesses. But given you're an early stage investor and you've realized what it is to be in the boat with a good founder and what it is to be in a founder of lesser capabilities, you realize how important it is. So you just have to focus on founders. It's just, there's no way around it if you think you're going to be successful in going on a ride for 8 years or 10 years or whatever, building a great company. So that's the why, I think.
Yeah.
Then what do we look for in a founder? That's a harder one. I think there are some common traits, and then there are like some case-to-case specific traits, I think. So one thing is that you want, obviously, ambition, because the business of venture capital is returns driven by the biggest successes. It's very asymmetric, the power law driving. So you have to bet on things that will become really, really big. And if you're lucky and or clever to hit those that become outlier returns, then you're succeeding, essentially. But the starting point for that is to have the ambition to get there. If you don't, you will not get there. So I think that's a common trait. Then there's a trait around, being strong on execution. And I think there are sort of, when are you good on execution? There are sort of sub traits of that. And, I think smart, efficient, quick learner are sort of elements of that, but they may not be the only ones. But ultimately, you have to be good at executing. There is some level of having to be like a good communicator and advocate for your startup or company. You have to win over customers. You have to, recruit talent. You have to convince investors. There's some sort of communicator element to it that has to be strong. And I think, just to succeed and be an outliner, you have to be extraordinary in some way. So the why you kind of thing, there's an element to it. And I think those are, common traits. And I think probably resilience is another one, because it's going to be that long journey to succeed, and you're going to be hit in the face on the road. So I think that is another one. And then you turn, you get into other things that are sort of more specific as to why you would succeed with the particular company or journey that you're setting out to do, and specific success criteria. But it's, to be fair, it's very, very, you can talk about all these things and you can have like ideas about these things, but nobody's perfect. That's one thing. And it's also very hard to judge these things. So whilst it's super important, it's also super hard, right? And I think a final note on it is that it's not about being perfect in everything. I think it's better to back founders that are really, really, really strong in a subset of things and are aware that they're not good at other things, and then, have a co-founder or add key team members to sort of complement. So like having weaknesses is not in itself a problem. It's about how you build a team or a founding team. Rather than sort of betting on people that are decent in a bunch of things, but they're not really all that great in any particular skill.
Yeah, it all makes total sense, and I think that's when you see that like the previous successful founders, they're easier for them to raise a new round and kind of build great teams and such. So I guess it's always easier when you have something on your CV from before, or you've been successful. It's harder for first-time founders, which I guess you do meet quite a few of as well. And it's how do you recognize these traits? Like one thing is kind of through the pitch decks, and obviously every time you speak to a person, kind of he leaves something behind, like an impression. But then also, like ideally, I guess you would like to have some kind of a relationship over time to really understand the person. But then the counter of that is like we're always too busy. You're busy, screening deals, and the founders are busy building. So what's the magic balance here?
I, it's a difficult one. So like obviously we like serial founders like everyone else, right? I think there's some things to experience in knowing what to do and not having to learn it on the way, simply because
sure.
One of the magic things of building a startup is speed, right? And doing things at speed. But if you have to learn everything, it takes down your speed, and it reduces the likelihood of succeeding at the first attempt. So if you already know something or you have experience, your chances of repeating it, doing something succeeding is much higher than if you don't. And obviously, so we like serial founders like everyone else, but we don't invest only in serial founders, we also invest in first-time founders. But even then, there's like, okay, so have you been in successful scale up, for example, in a key role, but you haven't been a founder before? It's still much more likely that you've done things that are relevant and have experience, or you've sat next to the person who did it, so you know who to ask, or you've sort of some learning has rubbed off, and you're also more likely to know who to recruit, who knows these sorts of things. So they're like, so if you've been in Spotify in Sweden, or even Oda is heavily discussed in Norway these days because of Carl's statements. But to be fair, they built a fantastic organization, and people who've been in that organization have learned a whole bunch of stuff, right?
Yeah.
So I think even if you haven't been a founder and you've been in the right places, that is one way to look at it. But if you don't have that experience, right, then it's harder to fundraise from somebody like me. And I think that's when the time dimension comes into play, right? Because if you see people over a period of time, whether that's like 6 months or 12 months or a longer time, you see what people do. And if you see that they keep knocking it out of the park, and they're executing really well, and they're executing really fast, and they're learning really fast, right? That's this kind of founder that you want to back. And as one example from Norway, I'm using Norwegian examples in companies that we've worked with or I work with. So for example, we're investors in 1X, the humanoid robotics out of Norway. And I've written a blog post about our investment in there because it took like five years from our first meeting to our investment. And there's a lot of it, we could probably be faster and all of these things, but there's like just a number of things coming together. The timing for that company, and having been prepped for a long time, is like just unbelievable, right? But I can also promise you that Bernt, the founder, was not the same person the first time I met him, 5 years before we invested, to the time we were invested, and now he's like on the world's biggest stages and look like one of those, top tier Silicon Valley venture capitalists. So that's this incredible learning experience, right?
Yeah, it's quite inspiring.
Yeah. So I can assure you, he did not speak the way he did in, the main headline on the TED conference this year, 5 years ago.
Yeah.
And so then, so it's hard. It's hard for founders, but it's also, we are, tasked with picking a few companies each year out of hundreds of companies we see each year as well. That's just the name of the game of what we do. And then it's hard to make those decisions, and we try to do the best we can, and we make lots of mistakes, and hopefully we make more right decisions and partner with more of the right founders than the ones where it's not a fit.
Speaking of decisions, can you kind of run through it? Like this time you mentioned this 5-year investment period.
It wasn't an active discussion over 5 years, just to be clear, because that's like beating a dead horse,
Yeah.
which turns out not to be a dead horse but a unicorn, right? Without at least lining up to be right. So yeah.
So, what is your kind of what's your process like in internal governance? Like, how do you decide to invest in a case? Between your partners and maybe also on average, how long does it usually take in a process with you guys?
So I'll say a little bit about how we're organized first. So we are 9 people altogether, but we're 6 partners. So we've decided there are like venture capital firms that are sort of more pyramid oriented. So the ultimate example being Andreessen Horowitz, for example. And some of them, so they have like senior partners and layers of partners and then layers of juniors and there's this like trickling through a large pyramid, and they also have like support organizations that at least offer to help on specific things. We've decided for extremely flat structure and being partner driven, and that means that founders meet partners in the first meeting, so decision maker in the first meeting, to avoid the slowness of the trickle through effect. And then the bottleneck is more getting time with the partner, maybe, but anyway, that's what we decided for, because it's very frustrating for founders to like have multiple meetings with juniors and then get to a partner who's not interested in the first place. Then it's better to get like the answer in the first meeting, right? So that's part of it, and that means that partners drive deals. And then if you start back from like the decision point, there's an investment committee meeting, and the partner who's driving the deal is kind of your champion, right? So if I meet the founder and I'm really, really excited about it, I need to find a way to get to a yes in the investment committee. And then I'm the one who that founder will work with, till an exit, unless, I get run over by a bus or something happens that I'm no longer with the firm. And so this, partners should only invest in things they're super excited about, because founders deserve partners who will be champions, right? And that's why it's important to have that, excitement with a partner, and partners sort of bringing it to the table. And, ultimately it's an investment committee. Typically the founder will also present in that investment committee meeting, and we operate by majority support, not unanimous decision making. So I need to convince at least 2 of my colleagues, preferably 3, that this is a yes to an investment at the decision point. And the reason why we're not doing unanimous is that the obvious things are typically not outliers. So we want to spur some friction and being able to do things that are not obvious, because they tend to become the outliers. So we decided very specifically that we don't want to have a uniform investment or a unanimous need to have a unanimous investment committee to make an investment. Okay, but obviously there's a process before that, right? It varies from company to company. There's typically at the end also written a memo, that's the decision. But whether it's how many meetings there are, how much negotiation there is, depends on a lot of factors, right? So typically the partner who brings it to the table needs to get enough confidence that you can defend it to get to a yes. And sometimes that confidence building is very simple. You see, there's quite frankly not that much to ask. The traction is great. The founder is great. You might get away with not that many meetings. In other cases, it takes time, and you need to mature into getting conviction. And typically then there are like subsequent meetings and drill down into specifics and maybe some documentation around it and so forth. And it typically after first meeting, the idea is that you get to a no very quickly if it's not going to go somewhere anyway. If it's sort of reasonably likely, you have a good gut feel about it, then you start to drill into things, and you drill into typically the things that will disqualify it. And that's simply the most efficient way of like being able to run more processes that are not time consuming for either party. So typically you ask follow-up questions in meetings or email or phone calls about the things that you're most likely to disqualify it, or at least where you have the biggest questions, right? And then that might be a cumbersome and many things, or it might not. And it also is impacted by how much, external pressure it is to get to a conclusion, because, you also don't want to lose a good investment. So I would, and also it's impacted, so typically you get to a point where you get convicted, you want to do this deal, then there's a discussion around terms. And that might be complicated or not complicated, and when you align around terms, there's a big difference whether it's a convertible instrument like a slip or a
safe
convertible loan or a safe, because then the due diligence and the paperwork is easier. If it's an equity round with like full documents and so forth, there's more due diligence, so that impacts the time after you agree on terms. So I'd say I think our best, the quickest investment decision we've made, sort of from first meeting to essentially signed on the term sheet, is like a week. And that's typically when somebody else has, it's an equity deal, but then somebody else is the lead. I think realistically, from first meeting till committed terms, if we are leading, is multiple weeks, maybe a month, from first meeting to sort of signed term sheet. And then if it's a slip, it could go very quick to money in the account as well. If it's an equity round, there's typically some weeks of agreements and due diligence.
Sure.
So maybe, but I would say, like, I think founders probably don't want to hear this, but I think the standard in Europe, or sorry, in the Nordics, with a few exceptions, is kind of from first meeting to money in your bank account in an equity deal is kind of like 3 months. And it's maybe a month of like figuring out if there's a fit and a conviction. There's maybe a few weeks of negotiation, and then there's like a month of agreements and due diligence things. But the exception is like incredibly competitive deals go faster.
But I think it's good for founders to know, because I think a lot of them are kind of planning for shorter times. So it's good to know what's ahead of you. You mentioned due diligence, not the most sexy thing, but it's important. But kind of the challenge here, I guess, on your side is like, as earlier you go, there's less information, there's less stuff. So, but from your perspective, what is your expectations from a due diligence, or what do you find, or what's your expectation for a level of the data room and an early stage?
Yes, I think I'd also like to bring a perspective on what is due diligence, because there are also investors in the market who are less experienced in the venture market, who operate differently and operate as if it was a different asset class. So I think it's very important that when you sign a term sheet, that's not when you start doing deep dives to figure out whether you want to actually do the deal. When you sign a term sheet, or you sort of in principle commit to doing a convertible or something, you should have done all the work to decide if you on principle want to do this investment. So walking away from a term sheet or a commitment to do it is bad for you as a venture capitalist, and should be bad for you as a venture capitalist. There should be very, very specific reasons for doing that. And it shouldn't be like a term sheet or a commitment should be like an option to invest after you've done a due diligence. I think that's very important to get across.
I agree.
There are people who operate differently, but we don't. And I don't think anyone should. So, and therefore I want to say that there's like a pre-principal commitment due diligence, where you should do all the things to decide whether you want to invest. And that means interviewing customers, figuring out the business model, figuring out whether, reference founders, do I really want to do this investment should be done before you commit on a term sheet level or on principal level. So I count that as kind of, it's not strictly speaking due diligence, but that's the actual work. And there's a data room thing that helps, get to a conviction and a commitment. And that's not so formal, but it's very important. And so that's data supporting the investment process.
Yeah.
And you can view it in an investment, in a due diligence light, or you can view it in an investment peer light. And I think that's the most important thing.
Mhm.
And then I think there's a post-commitment but pre-closing due diligence. That's a formal due diligence. And that's looking at legal agreements and and then you need a data room that's very detailed on all the contracts and financials and all sorts of these things. But in my mind, this is confirmatory.
Yeah.
If what the founder told you and have given you data on checks out, then it's an automatic that you invest. And that's like a confirmatory or post-commitment due diligence and the formal due diligence. And both of them are important. I actually think the most important is the first one. That's not strictly a formal due diligence. The other is also important, but you shouldn't be surprised. So if you're being surprised at that time, you haven't done your proper work before, or the founder has deceived you. And that doesn't happen often, but that's when you should, that's when the due diligence, the formal due diligence actually turns into something critical and difficult, right?
Yeah.
So there's there's a massive exclusivity that sort of hinders the company of growing outside of one customer, or you find out that the accounts are not real, or there's a 10 million NOK debt that you weren't told about, or these things that shouldn't be there turn up. Then it's either serious enough that it's a walkaway situation, or it's a negotiation situation.
Yeah. And during a fundraising process, what would you say is kind of the most kind of where do you see founders struggle the most, or make biggest mistakes, or the flip side? What would kind of any advice you can give to founders on that?
Yeah, so I don't think founders make a lot of mistakes as such. I think founders are generally good. So I think there's reason to compliment founders. That said, there's always room for improvement, and there's always sub-optimalities in process, and there's it varies a lot. But if I were to say, okay, where can it be improved, or how can the process be better? I think founders should be they focus too little on themselves and the team, I'd say, because I said before that if it's a pre-seed, 98% is the team, right, or the founders. And if that's so, how come is the team slide number 10? And it says, I work in this company and that company, and this person worked in this company and that company. That doesn't really answer the why. Why you? Why are you uniquely positioned to go after this opportunity, and what are your unique? So I think, Nordic people are less sort of high on themselves than an American founder who will tell them from here to the moon how great they are. But I think you should allow yourself to be a little bit more like that, because the why you question is a very important one. And I don't think that's not slide 10. And even if it's not slide 1, I think you should start your intro to a meeting as to why you're uniquely positioned to this, because it's so important to it. So I think that's one key suggestion. I think there's some sort of evaluation around fit of you as a startup, and fitting the venture model and the particular venture firm you're talking to. So I think if in a way, it's efficient to talk to 100 investors with the same story. But I would go to say that, having a quality conversation with 5 or 10 is more likely to yield results than a bland discussion with 100. And then, therefore, also choosing who you talk to because of fit and sort of communicating around that fit is a good idea. And I think also maybe there's generally, and this is not in pre-seed and so forth, but generally room to be better in the mastery of telling your story with metrics. But now we're sort of in the late seed and Series A type of game, maybe more than in the. But I see companies from other regions being better at that than in the Nordics.
Yeah.
But
Talking about metrics.
Yeah, sort of. Yeah, so mastery of metrics from a fundamental perspective and mastery of the detail of the business, and then using that as a block for the storytelling around why your startup is super interesting and why it's performing well.
Yeah. So it's really interesting that, it's about teams. So we had that discussion quite a few times with founders, and like, because I think you're right, and we've done the same. But how would you, like, in a pitch deck, there's certain standards what to include, right? And there's always this team slide, but there's, in a short deck there's only, like, you're gonna have 10 slides or so. How could you convey the message about the team in a better way than you see on most kind of pitch decks? Any advice on that for founders?
Yeah, so I think one way that's very effective if you have that way is kind of like the origin story, right? You start your meeting with your origin story, and and oftentimes there are founders who've been on this path of this. They've experienced some dysfunction that's a big problem, and they have tried to fix it in a corporate that they were for 20 years, and they've tried and now they've given up and they've decided to go after it, and then framing it into the deep insights and then the why it's a big opportunity kind of thing.
Yeah.
Or some others. So they're typically you can sort of the origin story itself might be different from person to person, but typically the origin story goes into then explaining the deep insights and your unique perspective, and then framing it into the size of the opportunity. So, and I like, a lot of good founders manage to start the conversation with that.
Yeah, it's smart. Yeah, I like that. Good. Okay. So on the flip side, like, are there any kind of instant or red flags that instantly put you off a deal?
Yeah. So I think ethics is one of them, for sure. I mean, you just don't want to, you can, you look at personally hundreds of deals per year as a team, in the thousands. And, you need to pick, one or two for yourself each year, right? And find like a match with a founder where you're aligned on vision and aligned on conviction and all of these things. And I think ethics is sort of like, can you really trust this person? And it's just not worth the risk, right? And you don't like to be in those situations fundamentally, and it only brings risk to the companies, right? The other are sort of more lighthearted. I just get allergies from stupid questions. Like, so if people just present like they're not smart and haven't thought, that is it just doesn't get me going anyway.
Yeah.
So yeah. And I think also that this is not maybe in the first meeting, but sort of the lack of the learning loops, right? If you see it's not, as you move along in the process, they don't really understand the questions that are being asked. They're not moving along with like showing progress essentially in the process, nor in the company, right?
Yeah, makes sense. Okay, so if I'm a founder, what's the best way to kind of get on your radar? How do I? What's the best way to contact you guys?
Well, the best way to get on the radar is by building a great company with great performance.
Yeah.
But that's like not that useful an answer, I assume. I think there are multiple ways, and we're not the way where we say like, okay, we only do warm intros, or you have to do this or you have to do that. I think we meet people in all kinds of different contexts, and we also answer inbound. But obviously there is the warm intro thing. I don't think. I think best, sort of the way you get a head start is kind of like people I really trust and think are smart and really understand the game, saying you should look at this company because I think it's very interesting for these reasons, or they're moving along massively. And that's kind of like separating yourself from the noise, right? Because those kinds of conversations get bigger attention naturally, and it sort of zooms in on the importance with credibility important. So I think even if we do take, like we genuinely try to sort of get to the nuggets in the full deal flow, but there's no insurance, and there's always a risk that the nuggets get sort of stuck in the noise. You just don't see it, right? So I think like, but I mean, also I'm at events all the time and try to like. It's not an open door policy in that like I've had founders who come to the office and knock on the door and say, "I'd like to have a conversation." That's not the best approach. Not because I don't want to talk to people, but because typically in the day you're booked up with meetings and you have things to do, and it's a tight schedule. So the likelihood of like knocking on the door at the time it's convenient is just not very high.
Yeah.
But I try to be out there, and our colleagues are out there on conferences all the time, and I think and all kinds of settings, like having presentations or whatnot. I think the threshold for talking, there's a lot of times when I'm out there and people don't come up to me, and if I when I was in Silicon Valley and your tags as VC, you're being bombarded with people. So I think just reach out and try to have a good quality conversation. That's a good way of starting a relationship. And I think also if you reach out cold, like crafting the message so it actually fits me. I know that's more cumbersome for founders, but the likelihood of standing out is much bigger than sort of like a blast of a massive email where you think. So I think it's a lot about like resonance and relevance in how you communicate in whatever channel that you try to reach out in.
Yeah, you talk about kind of standing out, and also about this not seeing the nuggets, like because it's as with many things, you kind of get into this. People or things tend to become a process, also, and best practices, and then you can go and online and you can Google pitch decks, and it's all in the same format. So, how what do you think is the best way to pop out or kind of stand out from the crowd? Any tip on that, or any thoughts on that?
Yeah, so I think pitch decks are important to some extent, but they're not the be-all and end-all. I think founders who spend 80% of their time on pitch decks are not going to succeed. You need to spend at least 80% on, the team and the customers and these sorts of things, and ultimately that's what builds the business. And a great business shines through a mediocre pitch deck, but a bad business does not shine through a great pitch deck.
Good put. Yeah.
I mean, there's a level to where your pitch deck needs to be to like bring credibility, But ultimately, a pitch deck. What is a pitch deck? It's the start of a deeper conversation, and ultimately, it's the deeper conversation that leads to investment. And the pitch deck or the blurb email or the conversation at an event at Startup Lab or whatever is the starting point. And the quality of that conversation might be as, or the blurb email getting my attention, why it's relevant to me and resonates with me, might be as important as the pitch deck.
Yeah, sure. So, okay, so if I were to send you some blurb, or like we haven't met before, I'm sending you a kind of an outreach. Do you prefer having just kind of a blurb? Do you prefer to have kind of a one-pager, or even like a PDF version of the pitch deck? Can you give some thoughts around that?
Yeah, I think blurb and a short deck is the way to go.
Yeah.
Because if those are good, then you will get a meeting, and then it's the rest of it is up to the quality of the conversation, right?
Yeah.
Why do I think the blurb is important? Is to actually get attention, right? But if it's only a blurb and not the pitch deck, and it doesn't, I'm not saying that you should send a pitch deck with all the glory details that might be sensitive and all of these things, but people who, if it's only a blurb and you don't get any more, you go, it's almost like you're hiding something, right? And so a lot of people, or at least some, say, well, I won't share the deck until we have a meeting. So sort of as like try to force yourself into a meeting, and that's just not the reason why I want to like have the whole story is not to avoid having good meetings. I really, really want to have good meetings. It's to be give a real judgment as to whether it's a fit, and if it's not a fit, you're better off not spending time with me. And as a founder, right? And if you, and I often, even if it's not a fit, I many times take meetings with the founders if they ask for a meeting. I say, okay, but can I still have a meeting because I'd like to have feedback on this and this and this. And then I typically take a meeting if I think it's at all relevant. And that's for two reasons. It's self-serving because it might be a fit down the line, and I actually learn more about the founder, learn more about the business to be in a better position to make a judgment in 12 months or whatever, when it might be, validated to a point where I can get to conviction. And it's also a good thing to build relationships because it starts. But if you take that meeting with a press saying, in the service of the founder thinking it's an investment process, when it's, you can't get to conviction of this, you started the meeting on the wrong footing anyway, and you're wasting everybody's time.
Yeah.
But if the founder wants to have the meeting to build a relationship and get input on something, I typically take it for that self-serving reason, but also because I think it's the way to be a sort of good ecosystem citizen when we have an ecosystem that's still developing, right?
Yeah, a good answer. So I see flip side as well from founders. Sometimes, like if it's a short deck, sometimes some stories are hard to convey with few words. So then I can see that they might tend not to want to send something without having the voiceover. But I definitely see from both sides there. What about like a one pager? Could that be some kind of something in between where you kind of put more wording than you would in a deck, or?
Yeah, I mean, I'm talking about a company today where I have a one pager, but that's a very, very crisp one pager. So I'm not saying. I also take meetings only on a blurb, but then the blurb is so good that I want to talk to these people anyway, right? So I'm not saying, and I don't want it, this is not, being sort of demanding in this respect is not to be an asshole about it. It's simply to try to be like honest and efficient, right?
Yeah, makes total sense. Yeah. Okay. So one last question. Like, if for founders looking at raising kind of venture capital from international investors, like bigger rounds, any kind of good advice to them?
So I mean, the great performance point of like getting our attention also goes for international or global investors. But I think, if you're a Norwegian company or a Swedish company or a Danish company where your context of everything is in Norway or Sweden and Denmark, and your team is there, your customers are there, your competitive space is there, it's really, really, really hard to get attention. There are like companies where the offering is like has no geographic limitation and it's all sold on the internet, and your customer base is like anybody who's found you on the internet. Those are typically out of the box fit for international investors if they are of the sufficient quality. If you're more sort of a B2B thing where you have like inside sales or enterprise sales, and it's like logos, not consumers or a statistically significant distributed business customer base, it's harder. And I think then you need to help in building the context. And so that's like showing mastery of markets that are not your home market, showing mastery of the competitive dynamics in those markets, and preferably having reference customers in those markets. And so I think that comes down to, if you build those kinds of B2B companies that are not like internet native, but like some sort of sales led and logo type business, I think going, not just raising money outside of your home market, but building the business outside of your home market is like a game changer for like the context you're putting the company in, the size of what the company can become, and your relevance for like international investors. And so I urge, like, from a fundamental perspective, try not to be sequential, right? Okay, try to get to break, get Norwegian logos or Swedish logos and get to break even, and then in 2 years we'll go and hit it. I don't believe in that, in sort of building a large company, and I don't believe in that from fundraising from international VCs. I think you need to take like a much earlier approach to finding a large geographic market and then putting yourself in that context.
Okay, good advice. Okay, we're getting close to an hour, so I think it's a good tip to round off on as well. So thanks a lot for joining the podcast, Arne. Great being kind of hearing more about your background and Alliance and your perspectives. So thank you.
Well, thank you for having me, and thanks for a good conversation.